Greetings, market rebels. Welcome to this week's macro measure. It is Sunday, March 31st, 2024. Happy Easter to all those that celebrate. It's a little in front of noon on the East Coast. Got a lot going on today with the family, so got to get to these and get them taken care of. So let's get going with our flashing of the disclaimer and our flashing of the intellectual property rights notice. And now we can move into our graphic, which I'm sticking with. We continue to get, I think, divergence overall between equities prices and what's happening out there. So it's definitely point counterpoint. There's a lot of great things that have happened in terms of how stocks have performed, but there's also a lot of things that are, as usual, off the radar and are becoming, I think, more and more concerning. So a little bit of change here to our weekly notes. I'm going to leave them up just for a few more seconds, and then we'll kind of reposition and get into things. But a lot of our call last week, if you want to call it a call, was that we were just kind of looking for status quo. And I think we got the typical holiday week with the kind of strong finish combined with the end of Q1. And that was that. So let me see if I can do the old stopping of the share briefly, and we can move into a better mode here where I can keep these notes going, and then we can get into some things. Let's do this first. Let's get over to screen four. Screen four. Okay, so we should be on screen four. So I'm going to run through some tabs. We haven't done this in a while. I think I've got them all somewhat organized, but they're all obviously related to really point counterpoint, trying to make sense of where we are, what's happened, where we've come from, and you've had the best quarter really since 2019. So quite a while, right? 5 years ago. That's the obvious part. Now against that, you've got this strong week, month, quarter, all-time highs, gold going as well, just so everyone knows. And you've had this 5-month performance that I think I've even got something on that. So we'll check into that. Just trying to establish really where things are and why I'm saying point counterpoint. So you know that stocks have soared, you know that crypto and crypto stocks have soared, and gold has soared. And in the last month, energy has also soared. So we were waiting for the metals space and for energy for the longest time. And then they both finally really started to go over the last 6 weeks or so, maybe 2 months. And it's been better, right? We didn't have a ton of paper in there, but we had some good opportunities here and there. And I guess the good point is we were ready for it from the chart work that we do every week. And we record here on the weekends, but that was the good news. But you're getting the typical thing where, right, these divergences just keep building, and you've got the soft survey type data is crashing hard, but meanwhile, the hard data is drifting higher. So that's part of the whole point counterpoint. But I think the important part that they've got in this kind of longer but graphics-based piece is that the expectations we've been talking about, right? The start of the year, they've had these 7 cuts priced in. Now they've got less than 3 cuts priced in. And notice how that didn't matter, right? That absolutely did not matter. So because, right, you're at all-time highs regardless. And remember that once they do start cutting, the performance 12 months later, according to stuff we found, I think, where was it from? What group was that? That was the Barry. Oh, I can't think of his name. But anyway, we'll try to track that down. But yeah, so you had this incredible 5-month run, 18 of the last 22 weeks. That's the best since 1989. Here's where they talk a little bit about energy being up in March. Tech did not do much, but a lot of other things came along for the ride. Some are suggesting that this incredible, I think, front running has to do with a change in government they think the market will like more. Not sure about that, but that's one theory that's out there. However, right, tech is, despite not roaring in March, is now over 28 times. So there's the multiple expansion coming back, and you're really very close to the your post.com bust highs, right? So that would be back in here. And you could see, I'm sorry, but that doesn't go back. I thought that was back further. My bad. Yeah, so I thought but they're citing that. I thought they had dates that went further. Maybe I looked at another graphic and I'm coming back to one that I didn't see before. Momentum was up huge. High beta was up huge. The other things were Bitcoin sensitive, obesity drugs, AI. You all know this if you've been tracking the market. So it's been really, for certain things, it's been remarkable. Mag 7 tacked on $1.7 trillion of market cap in Q1 alone. Remarkable, right? And implied volatility are very elevated relative to the vol of the S&P. So it looks, and that's very interesting. So let me flash that because, well, I'll stick with this for now. We'll have to go where we have a Mag 7 chart ready to go, which I think is important to keep an eye on this week. So those are some of the highlights in this piece. The survey inflation expectations are sliding. That's what the surveys are showing. The market's expectations, though, are not, and that's what I've been kind of hitting on in comments and the cocktail hours and things like that. So just be ready because I don't think it's all over. And this is kind of the funnier part where if you thought Nvidia was the big winner, cocoa actually outperformed it, and that just shows you the kind of inflation in cocoa that you've had really in this quarter. And they do note that oil, gasoline, pump prices all ripped higher, especially in March. We talked about that. So this is a good little summary if you want to go kind of read through this one, but just to kind of get an idea of what happened. But this is how absurd it really has been, right? So this is a typical election year, right? Every election year since 1950 through 2020, and you could see what we've done here. So this is why me and probably a lot of other people are saying that you really got to be careful. And I've been saying that now for a month, that it's time to be careful. And tech really didn't forge ahead, right? So that was the main thing we were looking at. So we're not taking a victory lap. It's just that we kind of saw that. I think the momentum sort of overall in the bigger areas that were working did come to a halt, but luckily through sector situation type of work, we were able to see other things that were emerging. Excuse me. So just to confirm, right, this is, people will wonder, well, how's that even possible, right? So here's your rate situation. And you can see that May, they're expecting pretty much we do nothing. Current target rate staying that level, almost 96% chance, but they've got it figured that you're better than about not quite 2-to-1 that you start getting cuts in June. So that's the expectation. That to me is still aggressive, but again, I would go with the market over my own take on it, just because the markets tend to sniff things out. But we have called the market on getting ahead of itself several times over the past few years, and I think we've generally been right about that. And here's some of the hyper rigging that's been going on. So the Philly Fed has had to admit that U.S. payrolls were overstated by at least 800,000. So we've been saying, right, that this happens under virtually every administration, but that it just keeps getting worse with each succeeding administration. So everyone that comes along seems to get more egregious with it, to fake it, and that's just because there's so many real structural problems in this economy, in this society, that all get glossed over. Interestingly, right, here's this tweet from Wall Street Silver: new home prices are falling at faster rates than we've seen since 2008. So, and they're down 20%. So that's very interesting for new homes because of the story we've all been fed, how that's been resilient and things are fine, the usual stuff. You can look this over, but this is one of the reasons some of these, not this particular tweet, but we have other sources that have sort of been hinting at all these things, like this is not happening. and they're now saying is higher for longer back. So this is some of this stuff anyway has been my general take from other sources as to why I've never really been on the rates or lower sooner bandwagon, and why I've questioned it for really how they've trotted it out over the past 2 years. And I'm still there. I just got to tell you the truth, even though I could be wrong, I'm still there. But I think we've been right so far about that. Um, Disinflationary path stalls as non-durable goods prices spike, but super core PC slides. So there's a little bit of stuff going on there. This is something that if you want to read some really bearish stuff and talking about the Minsky moment when basically the reality comes crashing in on the bubble, if you want to consider this a bubble. So you can take a look at that. I'm not going to get into that, but I just thought it was worth mentioning. Here's another thing, right? Renting now cheaper than owning in all the large metros. That just tells you how absurd, things have become. Interestingly, pending home sales, with the prices they've got, and in light of what we just saw, pending home sales hover near record lows in February, right? So that's not good. You all probably have at least heard of this, but if you want to read about the meltdown of commercial real estate, which could happen anytime, and that's why I think you've got to be really careful, because real estate and financial system problems are usually what, after markets have been overly stretched, they're usually what show up to be the boogeyman. So, and you've got that now, right? You've kind of got that stuff in the background under the radar, and no one's really following it, and talking about it in a big way yet. But that's very common. They only do that when they have to, which is after it starts impacting and they have no other choice. So this is why, to me, you've got to be roll oriented, and realize you're probably in the latter stages of this phase of the rally. There certainly could be, right, in my mind, more bull market behavior this year. I just think in the short run, there should be some sort of a pullback. And I couldn't tell you when, if ever, the commercial real estate, the regional banking sector issues and other things, or even consumer real estate, home ownership, when any of that starts to impact, but it has the potential to. Let's keep going. JP Morgan's actually warning about a flash crash, right? So don't want to put too much into those guys telling you this, that, or the other thing, but I think it's just, you've got to acknowledge that with this kind of relentless run we've had, and it's one of the best 5-month runs we've had in several years, not to mention 18 of the last 22 weeks, which is the best since '89. These are not things to take lightly in terms of your risk management, in my opinion. This is something that I've got on the notes this week, that 7 of 11 sectors have been, the EPS bars have been lowered. And this is what people like me always mention, but I wouldn't lose your mind over it. It's just that this just goes to show you, right, how if they beat, they normally celebrate, but usually it's after they've been forced to lower their bullish projections. But just like with interest rates not really living up to expectations in terms of cuts, EPS will often not do the same, and it really doesn't matter. They just keep going. I think a big part of that just has to do with, right, this kind of front running that things are going to get great soon, and they think rates are coming down. Which again is historically not been the case. Barry Ritholtz, his group, someone published something years ago that we've trotted out here and there in terms of a year later after cuts begin, things are not too super. We haven't done this tab stuff in a while, but I thought it was worth it because we're getting into a crucial time here where the end of the quarter, they kept things buoyed like we expected them to. Now they have to face reality before earnings start to come in. So there could be, right, a little bit of recognition of some of this risk between now and when the earnings start to really trickle out, which the big part of those tends to start about halfway through April. So we'll see. But here's some states flashing warning signs on unemployment. So there's 20 states now that are starting to show this uptick in the unemployment rate. So just keep that in mind, because that could start to pick up from there, which obviously wouldn't be good. Canada it's turning into a real cluster up in Canada. from what the stuff I've been able to come across. So they're maybe a little bit ahead of us. I hate to say that, but if they are, it's just not good. They had a housing mania. More as a result, mortgage delinquencies rose 52.3% in the last quarter of 2023. And credit cards are now going bonkers. And all of you probably know from Ryan talking about it or stuff we've done in videos or what have you, that there's that regional bank issue I mentioned. And these are all recent tweets. So it's just a lot of stuff under the surface that you got to be aware of. Remember, volatility is very low. And so there's just they're showing really that they're right now. Here's a percentage of states with unemployment rates rising, and look at the former correlations, right? So when you tend to get this big jump in the number of states with the percentage of states that are showing rising unemployment, it kind of coincides with really like a volatility spike, right? Because there's a recognition that takes place. So this is part of our coverage this week. These are all there for you to check out. A lot of them are from Twitter, and mostly all from Twitter and Zero Hedge. I don't have access to this, so the CTAs have never been more long. So commodity trading advisors have never been more long, while the open interest in futures on the S&P have hit an all-time high. So if you want to talk about a crowded trade where everybody's in, everybody's long is the most they've ever been at the all-time highs with all these other problems breaking out or at least percolating beneath the surface, there you have it, right? So we're just establishing all this. Also, smaller players have reached their most bullish net position ever. So even all the small timers, it's funny because my son gave me a call. He gave me a call over the weekend. He's visiting his girlfriend. As many of you know, he helps us out with the services at Market Rebellion, and he was just telling me his anecdotal report of everybody's a stock and crypto expert at this point, and that's definitely concerns me because that's what happened in the late 90s into 2000s, where everybody was an expert on all that stuff, and you'll all know what happened after that. Tech stocks are trading at all-time highs relative to the S&P 500. So they've got the premium in tech really, really, really up there, even higher than that bubble that we saw then. So just gives you an idea. Now that I'm not saying that it's unjustified, but usually, right, when you get this, it's not justified. It just could be, right, with AI. But my guess is they've priced a little bit of too much of perfection in ahead of time. Over half the U.S. states are now in a recession. Okay, so number of states showing increasing activity, that's plunging. The risk premium for the S&P 500 is now below the average investment grade bond, right? So you can get into an investment grade bond and get a better yield rather than owning the S&P. I think we've covered this. Oh, biggest loosening in conditions before the Fed cut. So we are seeing incredibly loose conditions. I think I might have had something else on that, or I skipped over it. My bad. But no, I think it may have been back. It may have been back here. Yeah. So yeah, I meant to cover this, but right now you can see that we are down there. Like we are getting down there. You've got to go back several years to find looser conditions than we have right now. So if you're wondering, if you're new to our videos and you're wondering, well, how can all this stuff be happening? And yet the market just keeps going. Well, the Fed's been sort of window dressing, tightening, but in reality, financial conditions are eased dramatically from before they're easier than when they started raising rates. So if there's more money out there, and a lot of this stuff just ends up trickling its way into the equity markets and just buoys things. Here's a very interesting thing that I came across with personal interest payments now exceed wages for the first time ever. I guess maybe since 2000. I guess if that's 2007 somewhere, I guess. Doesn't look like it is, but maybe it is. But yeah, it's far in excess of hourly earnings of production and non-super. So people are they're carrying a ton of debt at this point for everything: autos, homes, personal consumption, and their wages haven't kept up. And it's right. This is the stuff that nightmares are made of, because you could get a lot if you do get a reversal of fortune here in the economy. It's going to create all kinds of systemic chaos. Um, if you want to get even more depressed, you can talk about the wealth gap and the road to serfdom that they've engineered. But I think the real key stuff is what we've already covered. And that to me is that they've got everybody long. They've got extraordinary valuations. It's all back again, and it's not just small timers. It's some professionals, hedge funds, and things like that that are everybody's in. They've got a lot of people short too, which has helped as well to this point. But now, can they keep it going? So one of my arguments has been, why do I think that they will not be able to keep things going, and there should be some kind of a pullback here in the next month or so? Part of it has to do with the election cycle that we've covered. You can see that in the newsletters. We talked about it in last week's video. Part of it also has to do with the time of the year, and part of it has to do with, so the election cycle is normally not kind to the markets in the next couple of months. We reach this point where we need a correction, and we're really stretched, and valuations are overdone, and there's all kinds of other things cropping up like we just saw. So it's timing wise and kind of market condition wise, it all fits. So that's why I'm saying something should happen, not because I'm a perma bear or someone that thinks there should be a crash. I think the potential for a crash is definitely there, um, because of the so much risk and so much leverage, and how deep everybody's in, and how there's been sort of extreme front running combined with sleight of hand with all these economic statistics, which are just not even credible if you look at them. So there's a lot of, I guess, misdirection and so on and so forth going on. And I do think there's a lot of complacency. I mean, the VIX is barely above 13. It closed above 13 barely on Thursday. So there's a lot of complacency there. And it rarely looks better, so, which is in our notes this week, right? So I'll show some things now on the charts. Let's see if I can get the charts to show up. I hope my first chart comes up, and it is this one. This is what I was hoping for. So this is a chart of the Mag 7, and I hate that it switched me over to percentage. It doesn't really matter since it's just its index, but you can see that, right, we had a little bit of negative divergence from this high to this high in terms of these, let's just call them indicator oscillators, whatever you want to call them. So it's a combination of both, really. But so you're on the 20 right there, which is basically your support line, right, for this, the most recent part of this move. We connect all those lows. So I think you're at a crunch time for that. You've got gaps to the downside here, there, everywhere, depending on what you look at. And you're really due for something more. So I'm not predicting a crash. I'm just saying that the potential for a crash is there. I think usually the powers that be will do everything possible to prevent that from happening. But at the same time, when you're rigging so many things, you know, it gets super hyper engineered. It becomes a problem. And that's what we might be having right now. Let me just double check and make sure this has got the right share going. So we need to get rid of price axis. There we go. So this will get us back to hopefully dollars or points. But anyway, the point is, right, this had a heck of a run. It's showing some negative divergence. It's a little concerning to me because you all know, you could say, well, other things are replacing this and other things are acting really well. I don't disagree. It's just that everything else, if these things start to go into correction mode, the weights of them their weights are very large, especially as a mini basket. So that's going to make it very hard for the market to advance. Psychologically, though, the leaders rolling over isn't really a good look, especially when you're really overdone, and that could start to pull things down. So I think you got to keep an eye, I should say, keep an eye on these, you know, this week, because this is definitely a little concerning. And like I said, if I'm the gang, I would rather have like a nice little 2-week kind of pullback, you know, then I kind of churn a little bit. Then I start using probably most likely very good earnings from the financials because of the way the financials have been acting, to try to move things back up again. That would be, how I would handle it if I were one of the guys that moves markets around at my will. But I'm not. But I'm looking at it saying, right, this is the time to have your little corrective activity if you're smart. But the way that these things are acting, this has been utterly relentless in XLF. So I don't really think that. I mean, maybe I'm wrong, but I'd be very surprised if earnings are atrocious. They could be. I just the way things are acting, they don't want to let this go. I mean, it's incredibly strong, super resilient. They're not letting it go, and it just keeps powering to new highs. So with that in mind, I don't think that mid-month is going to be a bad situation unless, I mean, financials coming out mid-month, unless of course they have some bad things to say that are forward-looking, like, oh, we had a great whatever, but we're getting concerned that consumption was drawn forward and we see leaner times and delinquencies are picking up all over the place. That kind of commentary, which I guess that could be something that really would exacerbate the downside. But I don't think Q1 earnings will be the problem, just based upon how well these things have acted. So I just wanted to mention that. But let's get into looking at the 4 major index ETFs, knowing, right, that the Mag 7 looks concerning. So I've been saying this for a while. I feel like over the last couple of weeks, they've lost. I think they basically were able to use the Fed the way they typically do. And that's what ended up saving really that week. You could see we really did not advance last week, but that was a holiday week. There's certainly more room to go if they want to even come up to this kind of, we're calling it sort of like a mid-channel resistance line, but it's just been pretty solid overall. So we're sticking with it as a kind of like shorter term target rather than expecting it to reach the other side of the channel that we think things are operating in right now. But this is kind of, right, somewhat unimpressive, but how much do you read into it? Do you read double top here, mini double top here? I mean, you could, but it's really hard. I don't like when we have weeks that are shortened and holiday type weeks, because I don't feel like you can bank on your charts as you normally would. I think you have to kind of say, well, yeah, but that was a little bit of holiday-esque. Like, how much can I really complain that it put in a new all-time high? On that day, it's kind of expected the way that they mark things up. Supposedly illegal, but it happens way more than you would ever expect, right? If it were really illegal, it's really never prosecuted to my knowledge. But not that it's never been, but I've never seen it prosecuted. That is like marking things up, obviously. But yeah, so I think, your RSIs on here, you've got to be concerned about your weekly RSI at 78 on SPY. But again, much like last week, where I focused on letting everyone know, hey, this is where things could possibly crack, and then status quo until then. I think you have a little bit more of a wrinkle here because you could have a double top. But again, Monday's open could, set us on our way, and there's also room to run. So, I'd still be a breakout buyer. The daily charts are not that overbought yet. So I'd still be a breakout buyer, knowing, what they can do, and knowing what the trend is. More importantly, knowing what the trend is. And the trends are all up. So we've taken that position, right, since this really turned. We've taken that position of, if it keeps going up, we're going to keep going with it. And once again, another strong bull market phase. I can't say I was anticipating it to be some of the best stuff we've seen since 1989. I mean, I really, in terms of consistency, I can't say that back here near the lows, I thought, oh yeah, we're about to put a historic performance together that you don't really see. You only see 2 or 3 times a century. No, I didn't think that. It's just that, right, we said once it kind of left this consolidation, this corrective consolidation, we'd be willing to go along with it, and we wouldn't be shocked if new highs were made, and we would just keep going with it as best as we could. And I just think you have to keep doing that until you see a crack. And really, I hate to say it for anyone that's a bear, but the real crack would be at the 20-day in my mind. You may as well call that your support line at this point. It's not always that, but it just works out to where it's more or less the support line that I would draw right now for the real crack. I don't mean short term, very short term, pick up a single and then, find support. I'm talking about if you really think this market could crack, that's where I'd be looking at the 20-day. Other than that, right, just let's give them the benefit of the doubt at the moment. But do know that there is the chance 78 RSI on the weekly, and do know that they have a possible mini double top forming that could become something. So if it doesn't rally and in fact starts selling off, then you got to probably look at it like, okay, this thing actually could be shaping up that way, and I'd still be right. Whenever you get to support the first time, unless there's something that's material, right, in terms of like a really serious macro driver, or there's some sort of company specific news that's very material to the company's future prospects. When you just get down there in basic everyday trading, I would I would definitely make my adjustments there, whether that be trimming, rolling, both, closing, whatever, because usually supports the first time they hit it. It happened on Friday. Usually there's a bounce when they get there. It doesn't necessarily have to be a great bounce, but right, a lot of times they can pull something off. I'm pretty sure something like an SMH. I think SMH got down to a key level again, and I watched it on later in the week on Thursday. I think it was. I mean, sorry, on Wednesday and Thursday, they got it down below support there. Right. Again, we talked about this, I think, live that day, saying that they could. This is what they do, right? Kind of puncture these key areas. One of them was our support line. They punctured the 20, they punctured the 10, they punctured the 15. It looks really bad, but at that point when they start bringing it back, if you have been a bear and you haven't done anything, you have to really think about, I better do something, at least something, because these guys are the masters of, again, false breakdowns, reversals, especially when you come into the support for the first time that day, right? If you haven't been there in a while, like you hadn't been there in several sessions, you come back into critical support, they're usually going to hold the first time around without a really serious driver. But this is very interesting. This is probably more for sector situation stuff. But what I would say is, look, this is a big deal, this sector. We've been covering this like it's the sector that matters because we think it is the sector that matters the most, or has been. You've got a triangle forming there, right? You've got this lower highs put in. It would be very easy for this thing to crack support. I mean, I think if you take out Wednesday's low, you've got to be on guard. Now, that probably did close this gap, so it may have already accomplished its purpose and it could go from there. So the real breakout is naturally going to be above these highs, right? If you can get above 230.05, then you could be back towards trying to challenge the all-time high. But the nice thing about this is that the triangle apex is very close by. So we should get some kind of a breakout, I think, relatively soon. And you could draw this a little differently. If you don't want to draw it off the wick and you want to draw it off the candle bodies instead, that's fine. I would revise one and put one like that. Point is, you're still close to wherever you think the apex could be. It's getting there. So something should happen. I would not rule out that they keep going. I do think that SMH is, again, overbought on the weekly at about 75, and the monthly is the same. So it's about 75. They are overbought, but look, well, we pointed this out several weeks ago. That was the most stretch we could find in many, many years from the 200 or 100 or both. And so that's when you get that super stretch. We just made the mention at the time. You can't, and we said, the odds are against you really when you're playing the 100th percentile to be long. You got to be careful when you get that far. And so that's ultimately what I think technically led to this reversal, that super stretch. But now, right, you're overbought. There's no question. But at the same time, right, we know that this could really break up too. So it could break either way. So just be ready, because I think that could be an area in the next week or two that could get interesting just because of the way that the charts are shaping up. But getting back into it, you may as well go to the Qs now. And the Qs are a little bit sort of like more like the Mag 7 in that they're not as impressive, I don't think, as the SPY right now. And that's because I think other sectors and weights are working that, and tech hasn't really worked, right? So if you, as we saw, right, tech in July, I'm sorry, July, tech in March, nothing special, right? If we look at March here, we closed on March 1st at 445.61. We closed on the last trading day of March at 444.01. So tech represented by the Qs, nothing special. These are near overbought in terms of the monthly and weekly, but not even technically overbought. But they are losing a little bit of momentum. Like I said, I kind of felt like I've been seeing some distribution here and there where they're just using the strength whenever they try to rally to just be there as sellers and liquidate some of their holdings. Maybe some players think that we are due for a pullback. Maybe some players think they want to rotate money into, I don't know, other places like, I don't know, maybe transports or something, because those are on the cusp of breaking out, which we'll talk about in the sector situation. Who knows? But the point is, these are not acting as well as they did. It's not like they're not entitled to a resting period or, right, a pause type phase that I call it. There's nothing wrong with that. I mean, it's held trend, right? But so I think really, to get a real breakout though, you've got to be taking out this high. So that's about 1% plus away. And you're looking at the 20-day getting taken out here too, 441.61 for more downside. But even so, I think really with this rising 50 and where it would come in if we did start to slide, I think that's really your average to look for a trend crack in the Qs. If it stays above the 50, I wouldn't like, if it drops below the 20, to me it's a trade. It's not the trade like, oh no, the trend is cracked. I'm about to buy a new island in a few months after I nail this crash. I don't think it's that at the 20. I think the 50 is the key level there. So that's what I would keep in mind there. Let's see. Let's take a look at the diamonds. I think the diamonds may have started to come alive a little bit. They are barely off the all-time high. They're just a point off the all-time high. That actually looks more constructive like the spies do at the moment, where you could see that it's trying to move back up after pulling nice pop here, right? And then we pull back to support on the rising 10 in white, and you hold there, right? Which is on my scheme, right? Holding that it's the most aggressive one to hold. So if you don't give back more than the 10, right, you're doing great, because that's going to be the one that's closest to the action when you're in a rising, almost perpetually rising market the way we have been. So they hold it there. They start bouncing it. Is this really double top territory, right? Is it sort of, well, wait a minute, though. It could be a double top. It could. I mean, these things could be double topping. There really isn't a great divergence there. So it is what it is. And I don't really think that, I've been looking at this, and, I think I made the point like a month or so ago that people were nitpicking about breadth issues. And I think it was unfair. I mean, if you really want to find problems with things, I guess you can. And I have problems with it from an economic perspective and other factors that way. But in terms of saying, well, the breadth is terrible, I don't think that's the case. I think we've been objective about that and saying, like, look, these guys are bringing more sectors along, and the breadth measures, even these simple measures that are just on this particular review, they still look good. They might not be stellar, but they're still pretty good, and they're not really diverging that much. So there's a little bit that was here and there that if you want to be, but I really felt when we were talking about that more, it was nitpicking. They've all really started to do a little bit better. So it's very hard for me to sit there and say that, no, this market's got all kinds of breadth issues associated with it. And there's massive divergences that are opening this market up for dislocations to the downside based upon breadth issues. I just don't see that myself in the things that I look at. I do think there's been a couple things that have lacked that we pointed out, like they were interesting to keep an eye on. The one from Sven Henrich that had to do with new highs, new lows, things like that. It's the market in a way is not acting like it typically does when you have a really great bull market set up for years and years and years. Is acting somewhat differently than that in some ways, but in some other ways that are just kind of more vanilla, it's actually acting pretty well overall. And I would just note, and I'll talk about this more in sector situation, I would just note that most sectors are doing well, right? Like they haven't left anything really behind too much. Could you say some things have sort of cooled off? Yeah, but they were the former leaders and other things have joined. And I'll be focusing on XTN specifically. The things that do worry me, though, are that some things just keep remaining overbought or near overbought. That XLK, which is the leader, that hasn't really screamed higher. And XLU to me and gold acting as they are, that to me is a little concerning. Now they might say, well, they're anticipating lower rates. Maybe they are in XLU, but I just find it interesting that at a time like this, where I think the problems are building beneath the surface of the market, economically speaking, et cetera, not really technically, other than it's stretched and overdue. The health check on the market's actually pretty good, but this is a little concerning, which we'll just mention more when we get to the sector situation. Now, the interesting thing is, we said last week, keep your eyes, on IWM, because that's one of the key laggards, and if that starts joining the party, that would be good. I do think in one of the videos last week I said, we got a new long idea on, because we did see some paper, we liked the charts potentially, and we actually thought that if they did pull back and hold, right, have this pop and then pull back and hold at a higher level, that you could and find a support where you'd expect, and they did, right where there was confluence between the 10 in white, the 15 in red, and the 20-day in light blue, that would be an interesting thing possibly. And if rates rolled over, that could help the IWN finally break out, and had all kinds of upside potential because it's lagging behind the all-time high. It's lagging virtually the other 3 index ETFs we just looked at in a big way. And we don't even have like that inflation premium that we could add to that. So you have to admit, right, that this is your kind of reversal from downtrend to uptrend. So there's kind of your start to potential bullish activity. Then you get this corrective activity, and then you kind of get this attempt to break out and start to be another leg higher. And this is the most success they've had in trying to really break out above this level in a while. So this to me is very interesting and bears watching. It's not even overbought yet, too. So I had to put additional levels out because I didn't get that many out with the initial trade, but I'm pretty happy with the way that it held where we thought it could hold, and then started to make a new high by the end of the week. Now, the problem is, again, that's more or less in the, that's that late holiday week. Is it thin stuff or is it real? Tough to say. Tough to say. So those are the big looks. In terms of macro measure, there's really nothing that's that big that I can share aside from this. I do think it's interesting too that this dollar, that really gold and silver have been able to do what they've been doing, and oil as well, and energy, with the dollar sort of being stubborn. But we were saying maybe the dollar is kind of lagging behind TNX, and we said last week that maybe TNX might be having a mini double top from here to here, and it may have actually done that, right, where it started sliding and it slid a little bit further. So this is really close to taking out. I don't really think you can chart this exactly the way you would a stock price, but it is just worth noting that it could be failing if it doesn't hold these SMAs that it's near. It could be dropping down to a lower level, and lower rates obviously would probably be at least initially welcomed. Usually almost always welcome, but right now in this environment, it would probably be the way things are running, thanks to the excess eased financial conditions. And the VIX is probably our final one, and we'll wrap up. I'll just make sure I've touched on all those points, and then we'll get sector situation completed. But the VIX just world of hurt, broke. If you want to chart it that way, it broke the support line we had there. You dipped down, like we were talking about last week. It had a 12 handle. You got down to 1240. These are some of the lowest levels we've seen in some time. I do think, again, I'm not really our friend Ron that passed on. Ron liked to accumulate volatility when volatility was really cheap. And there's nothing really wrong with that. I think if you're a market maker or a desk trader or something like that, that makes a lot of sense to do that. Uh, if you can lay things off in other places and kind of keep everything under control, it's a smart move. If you kind of maintain it, roll it, all the things you can do. The problem is that unless you're really active as an individual trader, it's tough to fight off the kind of theta and vol risk that you've got by doing some of that. But what I would say is, look, if I put my mouse over just about where we are, you can see that going back several years, we really don't get too much lower than this too often. I'm more of a believer in when you really think the setup is there, then go ahead and start acquiring your volatility, because it can be really painful if you just keep buying it and don't really address it properly in terms of offsetting your theta and other ways to offset your vol risk. So it can eat you up, over the course of time. And then if the market keeps going, you've got all these super far out of the monies that did nothing for you other than, eat you up. So I'm not a big fan of that style unless, again, you're doing it all day, every day, which is what I think Ron was talking about when he used to discuss that. But if you're not doing this all day, every day, and that's part of what you do, it's sort of difficult to offset all the theta that can come from owning large downside volatility, taking positions that way. But you're getting there. And I think it's smart. Now you can have Ryan or Greg or someone, if you're in the services, go through the downside put butterfly with you this week. And that way you'll be prepared if there is something. But, this is sort of a sign of complacency, right? That we're about as low as we can be relative to the past several years. So just, you got to keep that in mind as well. So that's probably a wrap on things. Let me see if I can bring this over now. And if there's nothing more to say, we did talk about all that stuff. Again, most sectors are working. Several are near highs, but some are tired right now. I do think some buying has been reflexive, excuse me. But I think the breadth is fine. The momentum's not there in tech, as we saw. The VIX we just discussed. We talked about the possible TNX double top mini, and that sort of worked out a little bit. The dollar's still moving up. That's kind of a curious one right now, considering what else is moving up. And I said, like, trend support's holding. We're not in immediate danger. So it's more, to me, it's more status quo, except for where those levels I said on Qs and other things where you would start to get concerned about it. I do think that you still have to stay at a higher DEFCON, because I think if it does make sense for them to have corrective activity sooner rather than later, and then try to use the earnings to come out to mark things back up dramatically or create squeezes. The flip side of that is, if they flip the script, they could do the blow off top in the next couple of weeks that just absolutely takes 99% of people's breath away. Then the earnings could maybe potentially be set up for more of a disappointment, or guidance would be more of a disappointment. So I think those are your two big scenarios you're looking at right now. I do think that this is the timing factor. We talked about that. I still think there's more upside in this market, despite sounding like concerned. I just mean maybe after they get some unpleasantness out of the way. IWM put it together. We saw that. XTN is gearing up. I'll cover that more in sector situation. Problem is, right, it doesn't get too much better than this very often. So that's, again, a problem, really, if you think about it, when everything looks pretty good or very good, like it sort of does. That's a problem. And my issue, again, is that I do think there's been some distribution late, and I think the calendar has been good for everything. And I do think earnings are also something that can help them. And we all already know that basically, right, that easy conditions are helping this market. So keep that in mind. We didn't cover copper, but we talked about these metals, precious metals, and oil, and they were in pullback mode, but they started to find their mojo again. Copper is still in, but it could start to keep an eye on copper. If you want to see if that starts to run too, and these are strong, it's a good sign for, theoretically a good sign for future demand. Talked about that, talking to Ryan in the webinars. I still think risks are elevated. And the lack of the pullback, the calendar, these are things that have me concerned, especially the way the market's sort of looking tired or lacking vigor right now. And I just think you got to mentally prep. But remember, we're going to stick with, as long as we stay above trend, we're just going to stick with probably favoring the trends the way up, right, for now, until you start seeing some cracks. Now, there's a couple possibilities for triangles. You saw some mini double tops. You see that the VIX is probably, there's a lot of complacency. We made that case. So that's what keeps it really interesting and kind of keeps it point counterpoint. But until you start seeing the weakness, right, I would, if they're still trying to run things, I would just continue to go with it. That served us well, right, for 5 straight months, some of which are, this is really some of the best run we've seen since 89. So just having that assumption that bulls are in control, trend is up, it's not cracking support, those basic things should have kept our mindset focused the right way, which is to keep going with the momentum, because that's what a lot of our services that are momentum oriented try to do. So anyway, that's the summary for the week. I want to wish everyone a great Easter weekend if you celebrate Easter. Again, I'm Wayne. My partner is Ryan. All of you probably know Greg from the services as well. And we're going to get started on the second quarter, doing the best we can to help out in the markets. I'll wish everyone a great week ahead. It'll probably start to get real again because last week was holiday-esque. And I want to thank everyone for tuning in as usual. So everyone take care. Thanks for tuning in, and I'll be in touch through the week and certainly next weekend. Thank you.